The Bitcoin 4-year cycle is broken. That's not me saying it. That's what veteran crypto investors who have been in this game since 2012 are now confirming. And if you're still waiting for that post-halving explosion everyone promised you, you might be waiting forever, but here's what they're not telling you about what comes next. Stay with me for the next few minutes, because what I'm about to share could completely change how you think about Bitcoin, gold, silver, and where your money should be positioned right now. Welcome to the Wealth Continuum, where we cut through the noise and focus on what actually matters for building generational wealth. I'm your host, and today is January 25th, 2026. Right now, as I'm recording this, Bitcoin is struggling near $87,000 to $88,000, down from recent highs. Gold just touched an all-time high of $4,888 per ounce earlier this morning. And Wall Street, they're attempting a reversal after the sharpest sell-off we've seen since April of last year. But here's what you need to understand. Something fundamental has changed in the crypto markets. And if you don't adapt to this new reality, you could be left holding the bag while institutional money moves to the next opportunity. Comment below right now. Are you buying this dip, selling into strength, or just watching from the sidelines? I want to know where your head's at. Let me walk you through what's actually happening right now, because this is crucial. For years, the Bitcoin playbook was simple. Halving happens, supply gets cut, demand stays constant or increases, price goes parabolic. Rinse and repeat every 4 years. 2013, 2017, 2021, like clockwork. But 2025 defied that gravity. We saw Bitcoin rally to nearly $109,000 in December, then collapse back down. And now we're stuck in this range between $84,000 and $98,000, with $87,000 acting like an absolute magnet. But here's what they're not telling you about why this is happening. The 2017 and 2021 bull markets weren't driven by the halving alone. They were powered by something much bigger. Quantitative easing. The Federal Reserve was printing money like crazy. Interest rates were at zero. Liquidity was flooding into every risk asset on the planet. When they turned off that tap, both bull runs ended hard. Fast forward to today, January 2026. We're barely coming out of quantitative tightening. The Fed's balance sheet is still contracting. Interest rates, while lower than their peak, are nowhere near the zero-bound levels that fueled previous rallies. So Bitcoin rallying to six figures in 2025, that was actually remarkable. It shouldn't have happened based on historical monetary conditions, which tells you something important about what could happen when the liquidity taps actually do turn back on. Hit that like button if you're starting to see why this matters, because the next part gets even more interesting. So if the 4-year cycle is broken, what's the new playbook? What should you actually be watching? According to veteran investors who've been tracking this since the early days, there are 3 major factors preventing Bitcoin from breaking out right now. Factor number 1, the liquidity freeze. We're still in a tight monetary environment. Global M2 money supply, that's the total amount of money sloshing around in the financial system, has not expanded the way it did in previous cycles. Without that expansion, risk assets struggle. Think about it. Institutions are not going to pile into Bitcoin when they can get 4 and 5% yields in treasury bonds with zero volatility. The risk-reward calculation doesn't work until either yields come down significantly or Bitcoin's trajectory becomes undeniable. Factor number 2, the Clarity Act delay. Here's something most people aren't paying attention to. Major financial institutions, Fortune 500 companies, pension funds, they've all been waiting for regulatory clarity through something called the Clarity Act. This legislation was supposed to define which agency regulates crypto, SEC versus CFTC, establish clear rules for stablecoins, and give banks the green light to offer crypto custody services to their customers. It was supposed to be voted on weeks ago. It got postponed. Why? Because traditional banks are lobbying hard to block provisions that would allow yield-bearing stablecoins. Stay with me, because this is where it gets really concerning. The banks are terrified. One report suggests that if yield-bearing stablecoins become widespread, they could lose up to $6 trillion in deposits. That's money that currently sits in checking and savings accounts earning nothing for customers, but generating massive profits for banks through lending. If that money flows into stablecoins that can be transferred instantly, settled on chain, and potentially earn yield, game over for traditional banking as we know it. So institutional money is sitting on the sidelines. Legal teams at major corporations are telling executives, we want to move into this space, but let's just wait a few more weeks for clarity. And that's billions, potentially trillions, of dollars waiting to deploy the moment that legislation passes. Factor number 3, the 50-week moving average. From a technical perspective, Bitcoin has failed to hold above its 50-week exponential moving average, which sits around $94,500 right now. For traders who follow technical analysis, losing that level is significant. It's what many consider the dividing line between a bull market and a bear market structure. We had 5 or 6 days above that level recently, hit $97,000, $98,000, but couldn't close a weekly candle above it. Subscribe if you want to see where I think we go from here, because the answer might surprise you. Now let me show you something that should concern every Bitcoin holder right now. MicroStrategy, now called Strategy, just filed an 8K confirming they purchased over 22,000 Bitcoin recently. Their average cost basis? Approximately $95,000. Bitcoin is trading significantly below that today. So what does that mean? It means one of the largest institutional holders of Bitcoin is underwater on their recent purchases. And that $95,000 level isn't just a number on a chart anymore. It's a psychological and technical barrier reinforced by institutional positioning. There's likely hedging activity around that level. There's certainly awareness that breaking back above it would signal a return to institutional conviction. But here's the thing. Until Bitcoin can reclaim and hold that $95,000 level with conviction, meaning multiple weekly closes above it, we're likely to see continued chop between $84,000 and $95,000. There's even a CME gap at $93,000 that technical analysts expect to get filled. Historically, CME gaps get filled about 97% of the time. So a move back to $93,000 in the next week or two would not be surprising at all. This is where it gets really interesting, so don't click away yet. While Bitcoin has been chopping sideways, gold and silver have been on absolute tears. Gold touched $4,188 this morning, an all-time high. It's up massively over the past year, while Bitcoin has essentially gone nowhere since October. Silver has been following with its own strong performance, though it tends to lag gold initially before catching up explosively. And here's where things get interesting from a wealth preservation and portfolio allocation standpoint. The gold narrative. Historically, we've seen gold run first, then capital rotates into Bitcoin once liquidity conditions improve. Gold is the safe haven, the institutional money, the central bank buying. But gold at these levels, it looks parabolic. And chasing parabolic moves is dangerous. You never know when the top is in. Some analysts, including members of Trump's circle, have suggested that we'll see a correction in gold that flows into Bitcoin. That's what happened in previous cycles. But you need to ask yourself, do you really want to buy an asset that's already up 30-40% in a year and looks like it could pull back at any moment? Or do you want to position yourself in an asset that hasn't had its run yet but has all the structural catalysts lining up? The silver setup. Silver is fascinating right now. It tends to lag behind gold, but when it moves violently. We've seen this pattern repeatedly. Gold runs, silver follows with even more explosive percentage gains. For investors looking at precious metals as part of their wealth continuum strategy, silver might offer better risk reward than gold at current levels. But that's a conversation for your own research and risk tolerance. The copper opportunity. Here's one most people aren't watching. Copper. Copper has this really interesting pattern where it runs hard, then sells off 30-40%, then runs again. It's one of the most useful industrial metals for AI infrastructure, electric vehicles, solar installations, all the technology that's scaling up massively. And we're massively underproducing copper relative to future demand. Right now, copper's chart is looking parabolic again, which means a 30-40% correction could be coming. And if it does, that might be one of the best entry points we see all year for positioning in industrial metals. Comment below if you're watching copper, gold, or silver right now. I want to know what you're seeing in your research. So if the 4-year cycle is broken, if Bitcoin is stuck in purgatory, if institutions are waiting on the sidelines, what actually changes the game? Let me break down the catalysts that could unlock the next major move. Catalyst number 1, the Clarity Act, actually passes. When, not if, the Clarity Act passes, you're going to see an immediate shift in institutional behavior. Banks have already built the rails. They've been testing Bitcoin custody, stablecoin infrastructure, blockchain settlement systems since 2017, 2018. The technology is ready. The applications are built. They're just waiting for the regulatory green light. The moment that happens, major banks will start offering stablecoin services to customers. Fortune 500 companies will start moving treasury allocations. Pension funds and endowments will finally get the clearance they need. Retail investors will gain familiarity with digital assets through their existing banking apps. This isn't speculative. This is infrastructure that's been in development for nearly a decade, waiting for the starting gun. Catalyst number 2, the new Fed chair. In May 2026, we're getting a new Federal Reserve chair. President Trump will appoint someone who aligns with his monetary policy vision, and we know what that vision is. Trump has publicly stated he wants interest rates around 1%. Even if we get halfway there, even if rates drop to 2 or 2.5%, that's an enormous tailwind for risk assets. It changes the entire calculus for institutional allocation. When safe assets are yielding 1%, suddenly Bitcoin's volatility becomes acceptable for a portion of portfolios, especially if the regulatory framework is clear and the custody solutions are institutional grade. Catalyst number 3, tax rebates and retail capital. The Trump administration has floated the idea of massive tax rebates, reportedly between $11,000 and $22,000 per household. If that happens, it puts money directly into retail investors' pockets, money that isn't needed for rent or groceries, money that can be allocated to risk assets. And historically, when retail has excess capital and FOMO starts kicking in, that's when you get the parabolic altcoin seasons that create life-changing wealth for early movers. Catalyst number 4, stealth quantitative easing. We're already seeing the early signs of what some are calling stealth QE. The Fed's balance sheet has started ticking up slightly. It's not official quantitative easing, but liquidity is starting to flow. As this accelerates throughout 2026, and it will, under a Trump administration focused on economic growth, risk assets will respond. You need to understand this before I show you what's next, because this is the foundation for everything. Here's something most people aren't connecting: GDP growth projections. For decades, US GDP growth has hovered around 2.5%. We had some exceptions during COVID recovery, but the baseline has been pretty stagnant. Now, multiple reports are projecting GDP growth could hit 5% by the end of 2026. Why does this matter for Bitcoin? Because 5% GDP growth means capital expansion across the economy, higher corporate earnings, rising equity valuations, more money looking for higher return opportunities, a perfect environment for risk assets. This is the golden age narrative the Trump administration is pushing. And if even half of it materializes, we're looking at market conditions that are extraordinarily favorable for assets like Bitcoin. Trump is calling for massive deregulation, energy production expansion, manufacturing reshoring, and AI infrastructure build-out. All of that requires capital deployment. All of that creates wealth. All of that flows into risk assets when the monetary conditions are right. Now, I want to address something that a lot of you are probably thinking about: altcoins. The conventional wisdom right now, and I agree with most of it, is to consolidate into Bitcoin, Ethereum, and maybe stablecoins, wait for clear market direction, wait for the institutional catalysts to hit, then deploy into altcoins when you have confirmation of trend. But here's the exception to that rule. There are a handful of projects with asymmetric risk-reward profiles that are worth paying attention to before they explode. Let me be crystal clear. This is high-risk territory. This is not where you put money you can't afford to lose. But if you understand the risk and you're positioned appropriately in your core holdings first, there can be alpha in early-stage projects. One example that's getting attention from sophisticated investors: infrastructure projects focused on AI agent economies. Think about it this way. In traditional finance, we have KYC, know your customer. You verify your identity to use financial services. But in an AI-driven future, you'll have KYA, know your agent. When AI agents are trading on your behalf, managing your DeFi positions, optimizing yields across protocols, they need to be identified and verified too. That's infrastructure that doesn't exist yet, and whoever builds the rails for that economy stands to capture enormous value. These are the types of asymmetric bets that can generate 10x, 50x, even 100x returns in a true bull market. But they can also go to zero, so size your positions accordingly. Share this with someone who is trying to figure out their crypto allocation right now, because this perspective is critical. Let me be extremely direct about something. Leverage is extremely dangerous right now. I have personally heard stories of people I know and friends of friends who have been completely wiped out using leverage in this market. And I'm not exaggerating when I say some of these situations have led to suicide. This is a directionless, volatile, choppy market. Using leverage here is like playing with fire in a room full of gasoline. Here's the thing about leverage. It works when you have a clear trend. When Bitcoin is obviously in a bull market, moving up and to the right day after day, leverage can amplify your gains. But right now, we're in a range: $84,000 to $98,000. No clear direction, violent swings in both directions. If you're going to gamble, gamble when the odds are actually in your favor. Wait for confirmation of trend. Wait for the institutional catalysts to hit. Wait for the liquidity conditions to improve. The best strategy, the one that has worked for me and countless others who've survived multiple cycles, is simple: buy and hold quality assets. Bitcoin, Ethereum, and select high conviction positions that you believe in long term. That's it. No leverage, no trying to trade every swing, no emotional decision making. These assets are going to be multi-trillion-dollar markets over the next 5 to 10 years. The upside is still enormous. You don't need to take unnecessary risk to capture it. Hit like if you've learned something new today, and comment if you disagree with anything I've said. I read every single comment. So what should you actually be monitoring on a week-to-week basis? Let me give you the macro signals that matter. Signal number 1, global M2, money supply. This is the total amount of money in the global financial system. When this number is expanding, risk assets tend to rally. When it's contracting, they struggle. Watch this closely. Signal number 2, U.S. interest rates. Every Fed decision, every economic report that influences rate expectations, pay attention. Lower rates, better environment for Bitcoin. Signal number 3, GDP nowcasts. These are real-time projections of GDP growth. If we're truly heading toward 5% growth, that's a massive tailwind. If those projections start coming down, reassess. Signal number 4, the dollar index. A weakening dollar is generally positive for Bitcoin and commodities. A strengthening dollar creates headwinds. Watch DXY. Signal number 5, regulatory developments. The Clarity Act, new Fed chair appointment, SEC, CFTC guidance. These are binary catalysts that can move markets 10 to 20% in a day. The goal isn't to day trade these signals. The goal is to understand the environment you're operating in and adjust your conviction accordingly. Let's talk about realistic expectations for the rest of 2026. Q1 2026, now through March. Choppy, range-bound price action is most likely. We're in earnings season, tax season, waiting on regulatory clarity. Don't expect fireworks. Q2 2026, April, June. This is when things could get interesting. Tax rebates potentially hitting bank accounts. New Fed chair taking office in May. Clarity Act potentially passed. These are the catalysts that could break Bitcoin out of its range. Q3, Q4, 2026, July, December. If the catalysts hit and we get confirmation of trend, this is when retail FOMO could kick in. This is when altcoin season becomes possible. This is when life-changing wealth gets created for people positioned correctly. But here's the key. You need to be positioned before everyone else figures it out. By the time your uncle is asking you about Bitcoin at Thanksgiving, it's probably too late to make the really big gains. That's why we focus on building positions during uncertainty and doubt, not during euphoria. So let me bring this all together. The 4-year Bitcoin cycle, it's broken, or at least it's evolved into something more complex that depends on macro liquidity conditions, regulatory clarity, and institutional adoption, not just the halving schedule. Gold is at all-time highs, looking extended. Silver is strong, but historically lags before explosive moves. Copper could offer opportunity on the next major correction. Bitcoin is stuck in a range, waiting for catalysts. But when those catalysts hit, the Clarity Act, the new Fed chair, tax rebates expanding M2, we could see moves that make 2021 look tame. The institutions have built the rails. They're just waiting for the signal. And when they get it, billions of dollars will flow into this market faster than most people can react. So what should you do? Build core positions in quality assets, Bitcoin, Ethereum, select high conviction plays. Avoid leverage. Seriously, just don't watch the macro signals. M2, rates, GDP, regulation. Stay patient. The setup is forming, but it takes time. Position before confirmation. By the time everyone agrees, you're late. This is the wealth continuum approach. Understand the macro, position accordingly, build generational wealth through patience and strategic allocation. We're living through one of the most interesting moments in financial history. AI, crypto, reshoring manufacturing, energy revolution, it's all happening at once. The question is, are you positioned to benefit, or are you going to watch from the sidelines and wish you'd acted when you had the chance? If you found value in this analysis, do 3 things. Subscribe to the Wealth Continuum. We're diving deep into these topics every week. Hit that notification bell so you don't miss the follow-up when these catalysts start hitting. Comment below with your biggest takeaway or your biggest question. Remember, wealth isn't built by chasing green candles. It's built by understanding the game, positioning strategically, and having the patience to let your thesis play out. I'll see you in the next one.